We're live. You're in the right place. Getting started. Hey there, I'm Mitch Goldberg. Thank you so much for joining me. Really appreciate you that you've chosen to spend some of your time with me. We've got a few things to go over. How do we make sense of this crazy, insane world and put it together in the stock market, which is even more insane? Up is down, down is up. Good news is bad, bad news is good. What's going on here? Market makes a big turnaround after thinking that we're ready for a massive correction. And so we're going to talk about that, how to handle it, what are investors looking at, what are investors avoiding. There are two things investors are avoiding. And I think sometimes it's a lot easier to look at what to avoid as opposed to what to buy. So we're going to talk about a couple of things like that. While you're watching, if you have any questions, please hit me up in the comments. I love hearing from you. We're going to roll a quick intro and then we'll get started. Here we go. Hey, thank you so much for joining me. My name is Mitch Goldberg. We are just getting started. You're watching my live stream. It's called Be the Boss of Your Money because it's about helping you take control of your money. We go over a lot of financial education, investor education, personal finance, that sort of thing. A couple of things to talk about today. What's going on in the world and the market? There's a few big things bouncing around. Like I'm trying. I feel like don't we all feel like we're juggling? And I'm not. I could do mental juggling, but I'm not good at juggling in real life. Some people can just do that. I'm not one of them. But we've got Omicron. We've got record amount of COVID positive cases every day. Today is certainly no exception. People in the hospital, inflation, crazy high inflation. And Fed confirmation hearing was today to reappoint Jerome Powell as head of the Federal Reserve. I do hope he gets the nod. I mean, you could say he got it. He helped get us into a lot of stuff. He has to be the guy who gets us out of a lot of stuff. And then we have to talk about labor and some uncertainty and getting back to the office or not getting back to the office. The COVID fatigue is a real thing. And if you are somebody who has been told to work from home and then you're coming into the office and then no, hold on, work from home again. Nope, here's the date you're coming back to the office. Hold on a second. Hold on a second. We're putting that off for another month. Come back in a month, and then a month goes by. Not anyway. I think that's driving people crazy, and people have enough uncertainty in their lives. And I think what it's doing is it's really giving people a sense of. Let me fix my mic. It's giving people a sense of a lack of control. And we know there's a lot of things in life we can't control, but you can control when you go to work. You control when you set your alarm clock for. Controlling some of the little things in life, um, they're pretty important. Controlling little things, what you're going to wear, when you're going to get to the office, and first everyone's supposed to go back to the office in June. I'm talking June of like 2020, and then it happened later in 2020, and then we're in 2021. When do you go back to the office? And then finally, it just keeps getting delayed. And now we see companies like Facebook, Apple, Citigroup, major companies are delaying when people come back to the office. In fact, Citigroup said if you are a city employee and you are not vaxxed by the end of January 2022, by the end of this month, you're fired. And they said it affects 4% or less of their workforce. There are other companies that have done that, but Citi is the biggest one that I've seen so far. But if once one of them does it, the other big banks will probably uh, follow suit, especially with JB Diamond of JP Morgan, and Morgan Stanley, James Gorman. He's the head of Morgan. They are all trying to get their employees back to the office. They feel that there's a certain culture, a certain dynamic, a certain efficiency. Um, we'll see. In the meantime, people have enjoyed a much better work life balance. I almost said imbalance, but I, for one, like having the flexibility of being able to be home in the morning or work from the office on a particular day, not work in the office on a particular day. I'm usually in my office, and I'm fortunate that my office is only about 2.5 miles from my home. So coming to the office is just a nice, quiet place to work. But if I need to be home, I can still work there. Anyway, we've all got these things going on, and we've got to check into stuff here. Okay, so let's just do a couple of quick hellos. Bill, hey Bill, it is so nice to see you. I know I said we'd get together, I'd reach out. With COVID and Omicron, it just, when that's the question, right? And my daughter has COVID. I just found out my wife has COVID. I don't have COVID. I was tested yesterday. I came back negative. I'll be going for another test tomorrow or the next day. Hi, Jerry. Good to see you. And just so we know, Bill says hello to Jerry. Okay, so Jerry says hi to me, and he says hi, Bill. And Bill says back, hi, Jerry. So hi to both of you, and I can't wait to see both of you. Okay. Who else do we have out there? We've got Jay out there as well. Jay, thank you for tuning in. Happy birthday, Jay. Hope you had a really nice birthday. And you're a special guy, so I hope you had a special birthday. So let's talk about a couple of things, first of all. So wasn't the market supposed to go down? Yesterday, when the NASDAQ was plunging down about 3% in the morning yesterday, and it finally seemed this is it, lights out. Okay. You're welcome, buddy. And that was it. So the Nasdaq was down a little bit over 10%, fell below its 200 moving day average, which is a signal that uh, investors are really scared and want to get out. And lo and behold, things turn around yesterday. It's tough to say exactly why things turn around. You could say there was some bottom fishing, some stocks got cheap. I think part of it was that as Omicron continues to spread, like unlike Delta, which hit region by region of the United States, Omicron is just taking over the country by storm. And I think that maybe is putting a little wind in the sails of some of the work from home, stay at home stocks that have been pummeled. Just to reiterate, work from home, stay at home stocks, the Zooms of the world, the DoorDashes, the Pelotons, Teledocs, when you look at their highs, in my opinion, and I've been saying this on the show for as long as these stocks, as long for even before the pandemic, but I've been saying during the pandemic, let me correct that. During the pandemic, I said these stocks had no business being as high as they were. And as you can see, they've had substantial corrections. I don't see these stocks going back to their old highs. Are they tradable? Is there a bounce somewhere? Yes. But we talked about two things that investors want to avoid. The first one are companies that are trading on, some multiple of sales or some multiple of users. Investors are looking for companies that make money, and companies that make a lot of money. That's what they're looking for. So there shouldn't be a call against technology in general. There are plenty of tech companies that are in a very good position fundamentally, making a ton of money. But there are a lot of tech related companies that are not in a good position to make money. The other thing now is inflation companies that are getting crushed by inflation. Domino's is the latest in companies, which, by the way, Domino's was a stay at home, work from home pandemic stock. And that stock has been obliterated. And now they've come out and said they're warning because the cost of food ingredients is killing them. And then Albertson said they're having trouble keeping stock. They can't keep the shelves stocked. And that's happening everywhere. So I'll just show you something real quick. Let me move this over. Let me get rid of the this. Let me get rid of the social media icons. I'm on social media. If you didn't know, I'll pop myself up in the screen. All right, there I am. Let's take a look. This is what I want to show you today. I was with make this a little bit bigger. That's Antoinette Biordi to my right, and me. Black shirts rule. That was unplanned, of course. Black shirts, but I know when I'm going to see Antoinette, it's going to be a pretty intense discussion. She's a reporter with News 12, and what we talked about is inflation. Uh, you can't buy stuff today. There's a shortage of goods, and the Omicron virus is going to make things worse for consumer type companies that can't get their hands on things. Yesterday, Lululemon, which is a company which is known to be able to raise prices and caters to a high-end shopper, stock got crushed. It really took a big hit yesterday because of inflation. They can't pass costs. They can't raise prices fast enough to the end user. Okay. This is what I was talking. This is what I was talking about. Empty grocery shelves return as sick employees, supply chain delays collide. So here's the picture. Okay. That's the picture. In the picture says a lot. People are absent. People are calling in sick. United Airlines, a third of United Airlines workforce in Newark, New Jersey, which is a major hub for United, are out sick. They canceled 3,000 flights between yesterday and today. All airlines are offering pilots extra pay to work more shifts if they're not sick, that is. So we have a shortage of labor. And what happened is companies finally got on track. They finally got their labor back, labor policies, raised wages, which is inflationary. I'm not against it. I raised wages for my little workforce over here at Client First Strategy. And I'm proud that we could do it. I'm happy to do that. That's a good thing. Remember, your workforce is your best investment. So that's what's happening. It's just all of a sudden companies are starting to have trouble keeping people working because so many people are calling in sick with Omicron. Omicron is taking over the country. Is it a good thing in a way that we get this out of the way and we get back to life and back to business by the end of this month or the end of February? That seems to be the case, and that's why I think the markets recovered a little bit today, is because investors are looking past the next month or two. I have a different view. Companies that don't have earnings and companies that are getting socked by inflation are going to continue to sell off. So the reprieve you're seeing since yesterday afternoon and today in a lot of these former high flying pandemic stocks, yeah, they've gotten mauled, crushed, destroyed, obliterated. So they've been able to muster a buyable bounce. But it doesn't make the companies better. These companies did not get better in a day and a half. It simply means that sellers finally had enough. And since they started to stabilize, it brought in buyers and they've been able to get into a buyable bounce. But I'm encouraging you, and we spoke about this yesterday, if you're going to play individual stocks, I have no problem with that. I like individual stocks myself. Then make sure you stick to quality so that if you're wrong near term, you have something that time could bail you out. And Howard says flour up over 100%. Well, yeah, absolutely. I don't think you could make any food without flour. Although we did have flourless cake today in the office for somebody's birthday today, and it was pretty good. Left a little bit of an aftertaste. I don't know, but we have somebody with I don't know, some kind of food allergen, and we had a flourless cake. We have people here. We celebrate everybody's birthday, so we celebrate like 25 birthdays a year, and it adds a little fun to the office. I get my 3 o'clock sugar high. It's good. What the hell are we talking about? Oh yeah, let's take a look at how the markets did today. All right. Dow up 183 points. NASDAQ had a big bounce, up 210. S&P up 42 points. For the year, the S&P is off 1%. The Dow is off 0.25%. NASDAQ is off 3%. And the Russell 2000, that's a small cap benchmark, is down about 2.25%. The big news is, like I said, Domino's. Let's take a look at the pandemic stocks, actually. Okay. Let's just take a look at these. So Albertsons was down 10%. Domino's down 3%, down $16. Not a disaster, but look at that. 567. You see that over here? Do you see that on the screen what I'm pointing at? 567 down to 46. That's like a $56 stock going to 48. Okay. Kroger, Lululemon, 485 down to 346. That's a big drop. Okay, it's got $48 stock going to 34. Now, if people are still working from home, presumably they're still wearing leggings. So, but they said their costs are going up and they're not able to pass them on quick enough. Walmart, 152 down to 144. Not a disaster, but nonetheless, they have a big supermarket business. In fact, Walmart is the biggest supermarket now. And Target was up a little bit today. Costco bucked the trend today, up $3, but from 571 down to 522. So a lot of stocks that are very popular are giving up the ghost here. All right, let's just take a quick look at crypto. Crypto's coming back. You know, Bitcoin over the weekend dropped below 40,000. Today, yesterday and today, it's rebounding. Yesterday was in the like 39,000, 38,000 range. So crypto has rebounded. They all seem to trade as a group. I'm looking for the Doge. It's 15 cents. That's the one that Elon Musk talked up. People bought in at 60 cents, 70 cents, and now it's 15 cents. And this is what it drives me crazy when somebody has a big bullhorn talk something up like they know something, because people actually listen to that. And maybe there's somebody who doesn't have the sophistication or wherewithal to get that. That's why people like me, by the way, regulatory wise, we are required to be very careful with how we choose our words. But a good day for crypto. Okay, the VIX is 18. It was actually down a little bit today, so not a lot of fear. I would say that investors have found what they want. The super large tech stocks like the FANG stocks have come down a little bit, makes them more palatable. Amazon was not a particularly great stock last year, for example. And I don't think consumers or investors are too worried about those stocks. All right. It's really the companies that just don't have earnings. I think these are stocks that you borrow, you don't own, as a former branch manager, Alan, said to me many, many years ago. Okay. What's the big thing coming up? All right. The big thing, there's really not much else to say except until we wait till tomorrow. Tomorrow is the consumer price index number, the inflation figures. That is expected to be up 7.1%. Last month, it was up 6.8%. It was a freaky, crazy high number, highest number since like 1980 or since like 1980 or 81. So if we see 7.1%, it's expected. It's a high number. A lot of people feel as supply chains repair themselves, inflation could start coming down in the second half of next year. I agree with that, except for Omicron. Even China gets a few cases, they shut down a city. So I think the Omicron is going to delay the global supply chains repairing themselves. I think it puts a delay on things. And I think we'll start to see Omicron numbers go down when we get to springtime in North America, in the Northern Hemisphere. And that's when you should start to see cases recede. Maybe it goes back to being more of a regional problem, like in the Southeast, because that's where it gets hot in the summer and people congregate more indoors like they do in the winter in the Northeast and the Midwest. Okay. So that's my story. I'm sticking to it. The big number is inflation tomorrow. And there's really not much else to say. If we get a number higher than 7.1% in inflation, it hurts. If it's below that, it helps. Last thing, The reason for continuation of the market today is this. I'm sorry. I should have said this like right off the bat. Where the Federal Reserve is ending its bond buying program by March. In 2 months, it'll be over. That was money, $120 billion a month the Fed was putting into the economy by buying $80 billion of treasuries, $40 billion of mortgage bonds. They're almost done with it already. And then they're going to start raising rates. First interest rate increase is expected in March. Now, one interest rate increase is not a big deal. Two are not that big of a deal. But if they're moving in lockstep, like they're going to do 4 this year and 4 next year, which is the 5 maybe even this year, that's the expectation. Four is the expectation. We'll see where it goes. Okay. But then people also thought the Fed was going to let its balance sheet run off starting in March. The Fed has $8.3 trillion of bonds. As these bonds mature, the Fed would replace that money, the bond that matures with a new bond, or it could just let that bond run off and shrink the balance sheet, or organically as bonds mature. And we thought the Fed would do that in March also. So that's 3 things in March: higher rates, end of bond buying program, and balance sheet runoff. But now it looks like the Fed is, from Jerome Powell's testimony today before Congress for his reconfirmation hearing before the Senate today, he said, no, we really don't expect the Fed balance sheet runoff to happen probably until the end of this year. So we're not getting hit with the triple whammy all at once. And I think investors had a little bit of a sigh of relief on that. Doesn't change my thinking that investors are going to be sticking to quality. Doesn't change my thinking that if you're going to be a buyer on the dips, if you're going to buy the effing dip, as they say in social media, you really want to stick to the names that, if you're wrong over the near term, you should be right over the long term. And a lot of the companies that I see people buying, I don't think are going to be around for the long term. All right. Thank you very much. I hope you all are doing well, and I will see you tomorrow.